Hello and welcome back to the channel. Today we're discussing about investing in mutual funds. Do you want to start investing in mutual funds? Don't know where to start? Then this is the video that you should be watching. So what are mutual funds? Mutual funds are trusts that collect money from a number of investors who share a common investment objective, and it invests this money in equities, bonds, money market instruments and other securities, and the gains generated from this collective investment are distributed proportionally within its investors after deducting any expenses and calculating the NAV or the net asset value. So, before making a decision, we hear a lot of these terms: actively managed funds, passively managed funds, open ended schemes, closed ended schemes, hybrid funds, ELSS, debt funds. All of this causes a lot of confusion. I'm here to clear that confusion. So, without further ado, let's get started. Open ended and closed ended schemes. Open ended schemes are mutual funds that allows investors to invest in them on any given business day. You are also allowed to withdraw your money on any given business day. Closed end schemes. Closed end schemes are mutual funds that allows its investors to invest in them only during the initial offering period. These schemes have a specific tenure and a maturity date, and you're not allowed to withdraw your money before the maturity date. Actively and passively managed funds. Actively managed funds have fund managers working in full time deciding on where the funds should be invested in, whereas passively managed funds have fund managers who are relatively inactive in the market compared to the ones of the actively managed funds. These passively managed funds usually track and follow market indexes. In India, most of these passively managed funds usually track and follow the Nifty 50. ELSS. ELSS or equity linked schemes, as the name suggests, have more than 80% of their investment invested in equities. These types of schemes allows investors to save up to rupees 1.5 lakhs in taxes under the section of 80C. There's another point to remember, that you have a lock-in period of at least 3 years in these kind of schemes. These kinds of funds are best suited for people who are looking to invest and also save taxes on their investments. Debt funds. Debt funds are mutual funds that invest in fixed income instruments such as corporate and government bonds, corporate debt securities, and money market instruments. These funds have a lower cost ratio, have stable returns, and are considered much safer than equity based funds. Hybrid funds. Hybrid funds are mutual funds that invest in more than one type of asset class. This can be gold, equity, or debt. Because there's a mix of debt and equity in these kind of funds, these are considered a little more safer than the equity kind of funds, but are considered a little more riskier than only debt funds. Large cap, mid cap, and small cap funds. These funds, as their name suggests, invest in either large cap equities, mid cap equities, or small cap equities. In this, large cap is considered much more safer than the mid cap, and the mid cap is considered much more safer than small cap. Small cap funds are one of the most riskiest kind of funds that are available in the market today. Multi cap funds. Multi cap funds is a mix of all three: large cap, mid cap, and small cap funds. Each of these have a specific ratio within the multi cap fund. When the constituency of a multi cap fund has a minimum of 25% of each of these kind of equities, it's considered as a multi cap fund. This type of fund allows us to diversify our investment over the large cap, mid cap, and the small cap equities. Though this can be a risky investment because 50% of your investment is in the mid cap and the small cap. Flexi Cap Funds. Flexi Cap Funds are mutual funds that have investments in the large cap, mid cap, and the small cap equities. Unlike the multi cap, these kind of funds don't have a specific ratio of the investment. These funds can have a larger investment in the large cap and a smaller investment in the small cap. This allows flexi cap funds to invest according to the market conditions. Sector based funds. Sector-based funds are mutual funds that invest only in a single type of sector. This can be IT, banking, pharma, or any other sector. These types of funds should only be considered when we are sure that a single sector is going to outperform the index. Index funds. Index funds are usually passively managed and are made to match the performance of some kind of index. That can be the Nifty, the BSE, or the Sensex. Index funds are considered a safe option for diversification of our investment. One of the major advantages of index funds is the lower expense ratio amongst all other mutual funds. Now that we know the kinds of mutual funds there are in the market, we look into what we should be doing before investing. Create a clear investment plan. It is crucial for us to create an investment plan before considering mutual funds. We should be understanding our risk appetite, our time horizon, and whether we should be going the SIP route or the lump sum route. Look out for direct plans instead of regular ones. It is essential for us to look out for direct plans of mutual funds instead of regular ones. Regular plans have expenses and other brokerages included in them. Even though the difference between these two types of plans is less than 1%, the eventual gains over the years will have a very huge difference. Should NAV or net asset value be considered? The NAV of a fund is not an actual parameter to be considered. Consider two mutual funds, one with an NAV of 10 rupees and the other with an NAV of 100 rupees. If over a year both of these perform at 15%, then the eventual gain that you get is the same. Expense ratio. Expense ratio is an important parameter to check before investing in mutual funds. The lowest expense ratio in mutual funds is that of the index funds because these are passively managed, while some of these mutual funds can have an expense ratio that goes above more than 2%. The difference in expense ratio between two mutual funds can be 2% or even more. Considering the time horizon of your investment, this 2% can eventually be very huge. So that's it from me in this video. If you like the video, don't forget to give it a thumbs up. And don't forget to subscribe to the channel for more such videos. Until next time, bye bye.